The trend is your friend. And this is our second class in our Building Your Trading Foundation course. Now, in April, we'll be launching an entire new 4-week class for novices, beginners, and semi-experienced to take you through all, or give you all the information you need to understand, from the terms that we use in the market to how to use the platform, to understand indicators and oscillators, to learning chart pattern, in a 4-week class. And it'll start the first week, the first Tuesday of April, and run every Tuesday night for 4 weeks in April. So watch your mail for a mailer about this, or you'll be able to see it on the schedule come April. Now, learning how to read a forex chart or a financial chart is considered to be somewhat of a science. They look complicated at first glance. Charts can look drastically different depending on the options you use. Charts usually have settings for displaying style of the price, like candlesticks or bar charts, the time frame that you want to view, and this can be anywhere from a 1-second chart to a 10-year chart, and how that you would want to put indicators. Now, as we discussed in our first part of our educational series, there are 3 basic types of charts: line charts, bar charts, and candlestick charts. The bar chart was the most popular for many, many years, but now, due to the growth of computers and computerized charting, most of us have moved over to using candlesticks. But whether you're using bar charts or candlestick charts, there's only 4 pieces of information you're given, and they're the exact same price on all charts, and they're the exact same price whether you're looking at a bar or a candle, because price is price is price. That's not modified by any chart at all. And so we have the open, the high, the low, and the close. And it just depends on how it's displayed. But once we understand our financial charts, we then can start trying to decipher what price action on those charts is trying to tell us. And the first step in this, and that everybody should know, is trends. Now, don't mix up trends with trend lines. Trend lines are part of trends, but first it's a trend. And trading with the trend is trading with the flow of the markets. When the prevailing trend is up, why would you want to look for short entries when buying might result in much smoother trades? Many amateur traders, even when facing long-lasting trends that have been going on for months, can't stop trying to predict reversals. Now, when price is moving, it goes in a zigzag fashion. Whether the zigzag is steep, whether it is this way, or even if it's sideways congestion or a downtrend. But overall, what we're looking for as a trader is to decipher the trend. Who is pushing the market? Not because markets don't move straight up that way or straight down this way. But there's usually an underlying force. And a trend in a financial market or a financial chart is no different than the trend in dresses for women, high heels for women, cars. Like over the last few years, we've seen a big trend in cars. A lot of the big U.S. car manufacturers have done away with sedans entirely. So what we have are hatchbacks, SUVs, and trucks. The 4-door sedan virtually doesn't exist any longer. So if you would have been looking at car sales over the last few years and watch for how the sales in each one of these categories were going, it didn't necessarily zoom straight up, but you could eventually see that the overall trend was away from these 4-door sedans. You could see that maybe we were pushing into SUVs. The amazing part, we were pushing into trucks. Then we might have a trend in colors. We might slowly start to see that whites are slowly fading out and natural colors or metallic colors are slowly increasing. And this is a trend. But when you spot it and you can establish it as a growing trend, Why would you want to trade against it? I mean, if right now we could see that sedans were fading out and SUVs were growing, would you really want to go out and buy a sedan if you want to re-note or you want to resell it in a couple years? Because it's going to lose more value. It's also going to be harder. Women who want to buy dresses, do they buy them down the knee? Do they buy them below the knee? Do they buy them above the knee? Well, you don't want to go out and buy all your winter clothes to find out you bought what was against the trend. But same thing in trading. You want to establish when you can find a trend. But you want to trade with that trend because it takes a lot of energy for the markets to push up or down. But ultimately, there's some underlying factors that are pushing that market in a particular direction. Even though it seems like, oh, look at that. I can see that Apple is peaked up at as high as price. It's not going to stay up there. I'm going to buy it, sell it now because I'm sure it's going to fall down. Well, that's a big guessing game because you know what? It's like trying to catch a knife. I mean, you don't know exactly where it is. So, and then ultimately, and this is very important, ultimately, statistically, if you trade with the trend, you would tend to make more profit on your winning trades than you would in trading against the trend. But usually when a market is moving this way, like I said, it's moving in zigzags. Okay. And there's ways to explain this. There's cycles, there's waves, there's all kinds of things to explain it and get really involved in it. Okay. But if you try to sell here, the most you're going to get is down to here because the market isn't going to just pop up and reverse itself overnight. Yes, we're trading in very short-term trades when we're trading CFD and forex, but the markets don't tend to just reverse themselves. Something ends to start the volatility. But wouldn't you rather enter a trade here and get out here? Okay. Then trying to be chaotic and craziness of trying to guess where the market is going to or where the market is reversing. But even if you're not a trend following trader, you can combine the concept of trading with the higher time frame trends with your regular trading approach. You can start off on daily time frames and see if the trend is up, down, or sideways. And you can use that information on your lower execution time frames to trade your trades. Now, a lot of experienced traders will look at longer term charts to find the trend. They'll never trade against a longer term trend. Then they'll use the shorter term charts to decide their entry and exit point or where they're going to put their stop loss and take profit. And then they'll use the shorter term charts to decide just when they're going to enter the market. So a shorter term trend would be used just to help you decide an entry point to facilitate your trade. Your stop loss would be traded by the interim of that trend in a longer term time period because you need to be able to withstand the movement and swing of the market to keep your stop loss in a good place. But you would only trade with the environmental signals from a longer term trend. Now, that's not saying you have to use a 1 day, 1 month, and 1 week. You could use a 15-minute chart, a 1 hour chart, and a 4 hour chart. But it's important to understand where an asset is moving. Now, most traders only use bars and candles when it comes to observing charts, but completely forget about how effective and simple tool that allows them to look through all the clutter and the noise, and that's the line graph. And this is one of the few times that a line chart can really help you, is seeing where the overall trend is. So let's go over and let me pop up some live charts on your screen. So now we're looking at the pound. This is the current chart for the pound. Hold on 1 second, let me get it updated. Sorry about that. So this is the current chart for the pound. Now we can see this is a 1 hour chart. So we can see over the last few hours and the last day that the pound has been steadily trading upward. We can actually see a beautiful trend, and we can establish a trend line on here. Now, right now, we're not talking about the rules of a trend line, but we can actually see very, very quickly a well-established trend for that price. Now, I've also drawn on the chart right now an actually good a good trend line, because this trend line actually follows the rules of drawing trends. But we see that the pound is trading in a very nice upward trend. So wouldn't you have rather traded the pound and maybe entered somewhere here or here or here and rode it all the way up to here, then try to figure out, look at that, it's reversing and I'm going to trade it down? Because what happens is you can never get out of the market successfully when you're trading against it, because you have no idea what level this would retrace to, because it didn't retrace all the way down here to the trend line. And that's the point you would have been looking at. So it came down here and then turned around, went straight back up, which is what it should have done. But you were trying to guess these entry and exit points when trading against the trend. But now, if we were to look at the pound in a longer term chart, so let's go back and let's look at this in a 1 day chart. Come on, computer. There we go. Okay, now you can still see my trend line on this chart that we drew on the shorter term chart here, but it looks completely different. And now what we see is actually this could be a trend, just a retracement of a longer term uptrend or downtrend. We don't know, because we see now a lot of mess and congestion. We could say that the pound was trading in a downtrend and now is reversed and coming into a long-term trend uptrend since mid-December of 2018. Okay, but it gives us a different perspective on the pound. So we have a longer term, a short-term uptrend, a medium-term uptrend, and a short-term. Come on, computer. There we go. But look at that. We have a short-term downtrend. So we can see today, over the last few hours, this pound has been giving back all of its gains. So even though we saw it in the 30-minute chart, or the 1 hour chart, we might have been looking at a buying situation here and looking for a point to enter. When we looked at it in a shorter term time range, maybe we wouldn't want to enter that pound with a buy. Maybe. We're not making trading decisions now. We're just making ramblings. We're kind of prospecting and talking, because we're looking at different time frames. Okay. But this is what you do when you're looking for a trend. So you want to find the shorter term trend, the medium term trend, and the longer term trend. Like I said, a longer term trend is environmental. A medium term trend might help you decide that you're going to trade the pound going up, and maybe where you would want to put your stop loss. And then a shorter term trend would help you make your decision as to exactly what price or when you want to enter the market. But it's seeing the trends in price. Now, the thing is, you also have to realize we have 3 different trends. We have uptrends, we have downtrends, and what's the third? We can call it congestion, we can call it a sideways trend, but to be honest with you, the markets rarely trade in uptrends or down. The market actually spends most of its time in sideways, range-bound trading, not where it's staying between 2 prices and bouncing up and down where it's an elevator. It's usually in all this choppy mess moving sideways. And the market spent a lot more time than that, in that format, which is not something we can really decipher, as opposed to a nice developed uptrend and downtrend. Now, you can find these, you can force the rules. You can find these because it's just objective, looking at a chart and seeing this. But we could say, like what we're looking at now, we have a lot of sideways mess. Okay? We have a very short-term downtrend, but look at, if you try to decipher what happened between here and say here, or here and here, we had a lot of mess. We had this price doing whatever price wanted to do. Okay, now for the last few hours, we've had a very nice downtrend. Here we had a nice downtrend. Here we had a whole bunch of sideways mess. It's something that can't be deciphered. But now that we've looked at the trends, and trends are, like I said, simply observations of the market, no different than observing how colors are moving, how skirts are moving, how high heels are moving, how types of cars are moving, even how cell phones are moving, people buying PDAs. What's the next thing? If you notice recently at television sets, I mean, plasma TVs have become a thing of the past, not because they're not inventive, not because they're not great technology. They're just a lot more expensive. So where is everybody going to LCDs? If you could have seen this on a chart and isolated this trend, maybe if you owned a retail store, electronics store, you could have phased out your plasmas, not got stuck with all the ones in the back room. Or if you were buying stock in a manufacturer, maybe you wanted to get out of the manufacturers doing plasma and go to the guy who's selling LCDs. But that's a trend. And that's just a general definition of what this is. So let's go back to my PowerPoint. Now, also, a good way to identify a trend is by using moving averages. Moving averages can help us see how price is moving, because it takes a moving average, whether you're using a 20 period, a 10 period, whether you're using a 1 day, what it does, it takes the clutter out of the marketplace, because you want to be able to see these trends without all those exaggerated highs and lows. You want to see what is really happening, because like I said, the market doesn't just move up and down. It moves all over the place. But see here, if you can see, here we have all this clutter on the markets. But we can, with a moving average, we get rid of it all, and we can actually see some things that are going on. And there's actually a theory. It's not really a strategy, but it's a rule or a theory you might want to put into your trading, and it's called green light, red light. It means whenever price is above the moving average, you would consider buys. Whenever the price is below the moving average, you would consider sells. Okay, it's not to sell or buy it. If the price was below your moving average and all of your strategy, all of your, however you're making your trading decision, told you to buy, but the price was below the moving average, you just say, nope, my moving average is telling me not to do this. So you'd only enter buy opportunities when the price was above the moving average. Not the moving average is telling you to buy. You would only enter, no matter what you're using, when you will get the green light to buy when the price is over the moving average. If the price is below the moving average, you're getting a red light not to initial that trade. So trend lines are the next part. Trend lines can help us establish the speed, the momentum, and the future of what we expect price might be. Trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There's a lot of mis and inaccurate information about trend lines, though. Learning how to use trend lines effectively, if you're going to use them, is crucial, so don't fall into the common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets such as stock, forex, futures, cryptocurrency. Trend lines have the potential to alert us of a pullback, which is a move against the trend direction, is over, or the trend is resuming, or when a trend is accelerating or reversing. Price is the ultimate indicator, though. Therefore, price action must always be considered when using a trend. Now, trend lines are drawn on the charts to help predict the general direction of price. Trend lines will also help you determine good entry and exit points. Now, the main problem with trend lines is placing them on your chart. It can be a little intimidating to start with, but it is quite easy to get the hang of. Now, let's go back to our pound chart. And let's go back to our 1 hour chart. Okay. Now, we see a beautiful uptrend, and I was able to draw a very nice, a very easy trend line on here because we have a well-developed trend. But the fact is, the trend line isn't just drawn on a chart. A trend line has rules. And the nice thing about it is your trend line should match probably 1 million traders around the world. You're not trying to outsmart anybody. A trend line is a rule-based tool that will help you understand where you should get some reaction from the markets as price is moving. Okay. Now, a trend line can be drawn and redrawn over and over. In fact, it does. It's continually adjusted as price moves. Now, simply to draw a trend line is you need to find a significant low and project the price out into the future. And the bare essence is you must have a minimum of 2 points touching your trend line to bring it out into the market. That doesn't sound too complicated, does it? Nope, it doesn't. But the fact is, just connecting 2 points and drawing a line doesn't give you a valid trend line, doesn't give you a bit of information. And too many traders go on here and draw a zillion lines all over the charts. And what happens is those lines have no validity. They really don't tell you anything. They're making a mess of your charts. And therefore, so why have them? Okay, a trend line uses a important low. So in this case, this is a beautiful trend line. Now, some people use the body of the candle or a close for the trend lines. Other people, like myself, I use the low. You can use either. You just have to standardize it. You could technically use the open or the highs, but you have to follow one. That's it. You're not, because you don't want to adjust your trend lines to fit whatever your brain wants you to do at the moment. Okay, so when I draw them, I connect the lows. Okay, and I'm always looking to project out into the future, because once a trend line is broken by price, it's no longer valid. So you need to, first of all, draw a trend line that you don't see any breaks. It's below all the lows on your chart. Now, if we would have drawn it, because the trend line, okay, actually, this is a very, very nice trend line. It's actually a beautiful trend line and a beautiful trend, because even if I would have drawn it earlier as price moved, it was never broken. It's still good, and it's still a very good trend line. Okay. Now, once you connect, have 2 points that you can play forward, you can project the line out in the future. It means if this low here had come through it, that trend line was now over. You would have to redraw that trend line staying below that low. And even though you say, that was a freak of nature, okay, this trend line is no longer valid the minute it is broken. So you're constantly redrawing them. Doesn't mean it was a bad trend line. Don't misunderstand me. Okay, a trend line is good when it's happening, but a trend line doesn't become valid until it has a third point of contact. So in this case, we had 1, 2, 3. Now we actually have a valid trend line. But that's telling us this trend is quite strong, and this trend line is supporting price. So as price moved up, when it was retracing here, we wouldn't panic until it came down to that trend line. Okay. Now, it can retrace at any point, but we're looking for price to stay above that trend line. It is beautiful. Here, look at this. It comes down and respects that trend line. This tells us we have a very significant piece of information here. Okay. We could have, after this point, we knew we had a very strong uptrend, a very valid trend line. We would have considered buy opportunities and follow that. And look at that. We could have successfully traded the pound all day today to take advantage of this entire climb. It's still valid. It's still above the trend line. And if we were looking to re-enter the market or still entering the market at a later time, okay, we would have wait till we see how the price reacts to this trend line. We should see a green candle bouncing up and continuing that uptrend. Can't guarantee it. But if we see it break below, that means we're losing momentum and that trend line is no longer valid. We might have to redraw it. And but we're expecting it to bounce off of there and continue its up pattern. So a trend line is one of the few rule-based pieces of information that you have on your charts. Okay, so I'm going to share with you a little presentation that'll explain this to you a little bit better than I can, because it's going to give you some I'm going to share with you a presentation that's going to explain it, but use you some visual aids that'll help you see this a little bit better. And then we'll go back and talk more about applying these to your trading. So as you can see, a trend line can help you in your trading, but a trend line is also continually changing and adjusting. Now, one of the ways it is best to explain a trend is a series of higher highs and then higher lows. In other words, when price starts moving an uptrend, it's going to make higher lows. Higher highs. It means price is continually hitting a higher price. When it eases back down, it's going to make what's called a lower high. In other words, these lows are always higher than the previous lows. So there's steps. Then it's going to make a higher high, and then it's going to make a lower high, which is this low, which is higher than this low. Then it pushes up to make a higher high, then eases back down to make a higher low, pushes back up to make a higher high, and comes down to push. And so what we end up with is a set of steps. Now, these steps aren't steps like you can run up and down on because they're not even steps, but there's a series of progression moving up. Yeah, sure, it'd be very, very nice if we had these beautiful steps, but they're not. But you can see in the price movement these stairs, and these are the waves or the cycles of making higher high, higher low, higher high, higher low. In a downtrend, it's just the reverse. And why do you always have to make a higher low? Because otherwise it would break the trend line. So what happens when it breaks that trend line is because the price is falling below where it was because the price had never broken that trend line before. So let me take you back to the PowerPoint for a minute here. Okay. So the purpose of drawing trend lines is to identify where possible reversals will take place. They can also signal when a change in the trend is going to occur. What is a reversal? It's a small move against the trend that's showing it's reversed. Okay, so what happens is you break the trend line or you bounce off the trend line. So if you have a reversal, you're going through that trend line, so your steps no longer exist. If you have a retracement, it's continuing on the steps up. So in an uptrend, we draw our line again along the lowest point in the trend without letting the line cross through price. You need at least 2 touches of the trend line. So in other words, we look for price underneath, and this looks very much like that pound chart. I mean, the pound just happened to be trading today in this beautiful uptrend, which is very rare to find, but that gives you lots of trading opportunities. But here, this is a sketch I've been using for years, and it looks just like that pound. But you would project it out forward, you get your 2 points touching it, it gets validated with the 3rd touch. So there are 2 main types of trends, bullish trends and bearish trends. Bullish trends, you look for the swing low, and it's the strategic swing low. Because like if we look at the pound today, this is the actual swing low here. Because technically it's defined by the lowest point. But because it wasn't strategic, because it went into a whole bunch of sideways mess there. So we can start a trend wherever we want, but we can't just arbitrarily start it here. Okay. So here we look for a strategic swing low and projected it out to the future. Okay, and a bearish trend line is drawn the exact opposite. So you notice a bullish trend line or an uptrend is drawn underneath the prices and is supporting the prices over top. In a downtrend, we're doing it just reverse. We're drawing it on the highs above price because price is falling down and it is supporting the price moving below it. So your trend is your friend, but like all friendships, it's a complicated one. Unless you understand the nature of the trend, your friendship is destined to fail. As any trader quickly realizes, there's a great deal more to trading successfully than merely identifying a security's trends and buying pullbacks in an uptrend and shorting bounces in a downtrend. So again, an uptrend is a series of higher highs and higher lows. A downtrend consists of lower lows and lower highs. Exact opposite. Now, there are two major obstacles that we'll run into when you're trying to apply this wisdom. First, not all trends are regular. In other words, while one type of support level may hold well in an uptrend, such as using maybe a 20-period moving average, in another trend, it might hold at a 10-period moving average on an average pullback. So the trends can be all over the place. There's no hard defined rule of the angle it must be on, and trends can readjust themselves. A market could be moving this way with this steep move upward, and then could go here and then start still moving in that uptrend, but not with the same momentum or the same depth it has. Because ultimately, price action and the momentum of the market is what is deciding on a trend. Every one is individual. So you have to keep in mind that no trend lasts forever. At some point, an uptrend will become exhausted and will break through support instead of pulling back, and then continue higher once again. So without a solid understanding of how trends exhaust themselves and the tools for recognizing different types of exhaustion and how they affect the correction of a trend, you can easily find yourself on the wrong side of the markets. Most traders who pick up a book on technical analysis will run the concept of trend formation or trend development, whereby the trend consists of a series of 3 waves of the upside that are punctuated by 2 smaller corrective waves. Now, to be honest with you, okay, I'm going to tell you point blank. There are all kinds of things out there about these waves and these cycles, and we have indicators like GAN fans and all this stuff. Okay. Personally, I don't use these cycles. I don't use these waves. But lots of people swear by them, and lots of the market gurus, people who have been trading for 100 years, can spot them, find them. But you can have a wave within a wave within a wave, because remember, we had a short-term trend and a long-term trend. So it's identifying where you are in these waves. I just don't use them. Okay, it's not saying they're bad. Okay, it's something you'd have to master. Now, trend lines are one of the most used and misused tools in the trader's toolbox. If you're going to use them, you have to have a consistent methodology that defines when you will draw them, where you will draw them, and what you do when price touches them. Too many times I have seen traders draw random lines on charts with the argument that they might be useful. And so it's good to have it there. I tend to disagree. If you don't have specific rules, then you can draw trend lines you wish for. So you can force those lines. You can because you can always draw a line on a chart. But if you don't have a set of rules that you're using, you just wish upon a star. You wish that trend line on a chart. And if you do not have consistent rules, then you're probably just drawing random lines on charts that won't really help you in your trading. You need to have rules that will make sure you have a valid trend that's giving you good information. So first of all, we should define what we expect out of our trend line. There are legitimate trend lines connecting lows of a move to highs of another move, drawn on a best fit effort through the center of price action, or drawn through any number of other chart points. I have not found most of these be useful in my own trading because I expect something very consistent from a trend line. The main reason I will use a trend line is to delineate the conditions that define the current trend of the market. If the trend line correctly defines those conditions, then penetrations of that trend line are quite significant. I use a very strict rule-based trend line. Okay. It's not part of my trading strategy. It tells me that it's my line of support, it's my line of resistance. And I combine that with support and resistance levels and pivot points and my red light, green light. But this is as far as I go. Okay. So we will explore some further refinements of using trend lines in future classes. But for now, let's focus on the most important element, consistency. There is one specific price point that a valid trend line should capture without cutting through other prices. The low immediately preceding a new high of it for the trend. Ideally, the trend line should also extend from the actual beginning of the trend. But that is not essential, like I showed you on the pound. But if the trend has accelerated, it will not be possible to draw a single long-term trend line. So note that the trend line may cut through prices past the high, but should not pass through any price bars before the low. So as you can see on here, we've had to redraw this trend line many times as prices move because we're redefining it based on price action. And now we have the current trend line here, which then was, see this touch here, it was very active, but then once it got broken, it was over. So all you really need is to identify two swing highs or two swing low points and draw a line connecting them. There you have it. Your chart has a trend line. But wait 1 minute. Even though you've placed a trend line based on two swing highs or swing low points, the trend line remains unconfirmed until it is hit a third time. So here we have this trend line. Beautiful line on the left. Now, when we extend it and then price moves through and the trend line is broken, this trend line doesn't mean that it wasn't a good trend line. It was a great trend line. It's now over. We would then have to find our new trend line. Now, we could draw that trend line right there. But the fact is, we don't have a third point to validate it, so it's not even a good trend line at that point. But the original trend line we drew, first touch, second touch, third touch, that third touch, when it got validated, we could have gotten a very nice buy move in there. Okay. And we would have exited the market, hopefully at that point or higher, and we still would have made some nice profit. But we were getting it at the very end of that trend. So even though you have a beautiful trend line on your chart, this may be what your eye wants you to draw, but this is not acceptable because price had broken. So this would have been the correct trend line. And it might not have helped you with your trading right now, but it might have helped you trading as price moved into the future. So you want to connect the low, swing low to swing low or swing high to swing high. The more times that prices bounce off that trend line or stayed above it, the more valid it is. But remember, the longer that trend has held true, the more likely it might be coming to an end because it takes a lot of effort to keep price moving in that trend. And each time the price bounces off the same line, the more likely it is that others are watching it too and playing the same game you are. This could help you get several good entries in a row, but remember, trend lines don't last forever. And you want to buy bullish trend lines, in other words, buy or trade with the trend. When price is moving up, you want to buy. When the trend line is moving down, you want to sell. So whether you use trend lines or indicators, price action is what ultimately determines how much money we'll make. Learning about price action, how trends move, is never a bad idea. Once we understand the basic concepts of how price moves, then trend lines become a more effective tool in helping us analyze price action. Prices constantly move up and down, even within a trend. While most traders know this, they have a hard time applying that knowledge in real time. Traders often wait too long for entering buys near the top of a price wave, panicking as it pulls back and selling at the exact time they should be considered buying. So let's go back, and I'm going to show you one beautiful chart that if we would have followed our trend lines and build a trend channel on it, would have given us a beautiful trade opportunity. So let me pop up the charts again here. Here we saw price moving in a beautiful trend channel. Okay, and this went on for a very, very long time, and it just recently broke out of this trend. But look at this. This was the trend line that we were using. Okay, price just stayed above it, still above the trend line, but we built a trend channel using a trend line above and below. Here we use the highs and the lows, But look at this. It stayed in this channel for August, September, October, November, December, January, and February, up until this point. So this is what I'm talking about. We would have wanted to look for this environmental. This is using a daily chart to give us our sell conditions. We would have been looking to sell in this price. And every time the price bounced up to the top of this trend channel, we could have sold it to come to the bottom of this trend channel. Okay. But this becomes a very complex area because you're looking for tops and bottoms. But you could have sold here because we were looking at a downtrend here. But see, when it bounced off of here, it was hard to get a buy opportunity. But we could have, if we entered the market here, we could have ridden this all the way down to this point and made some good money. But this is one of the ways to combine trend lines, and this builds a trend channel, which also is available on your tools. So you can just draw on here a parallel channel. See, we clicked on channel, you draw it on, and then you can pull it up, and you have your trend channel. So there's many ways to use trends and trend lines. Okay. So this is just a starting point for you to start with. And we have another class called this, The Trend is Your Friend, which is not part of the 3-week course. And in that class, we spend a great deal of time looking at trends and then strategies for trend trading. So we have that next month. And then again in April, we'll be starting our 4-week class. So thank you very much for joining us. Have a great trading day. And again, if you want to see a recorded version of tonight's class, just use the same link you used to come to tonight's class. Have a great day, and thank you for being part of the ETX family. Good night now.